Before Barack Obama leaves office, there will be a currency crisis. The U.S. dollar will collapse, and prices in this country for consumer goods are going to go ballistic, and so will interest rates. And we're going to be living in an economy with unemployment closing in on 20% and double-digit inflation and double-digit interest rates. This is economic ruin that is coming, and it's because of the very policies that you're wanting Barack Obama to pursue.
And Rick Kelly is the only.
You know, by the way, there was a, you know, I took this exam yesterday. It was it was an 8th grade exam, and I flunked the exam, right? That was given to 8th graders.
My guest today has some answers and some predictions of what may happen here in the near future. Peter Schiff is a stockbroker and analyst.
We were in a bull market from 1982 to 2000. Bear market began in 2000. It's probably going to last another 5 to 10 years. I think the bulk of the downside is going to happen in the next couple of years. We are in the early stages of a bear market. This bear market is going to last for a long time. We were in a bull market from 1982 to 2000. Bear market began in 2000. It's probably going to last another 5 to 10 years. I think the bulk of the downside is going to happen in the next couple of years. As I said, my prediction for the Nasdaq is it's going to fall to around 500. You know, right now, you know, about 1,700. Got a long way to go down. The Dow Jones still above 10,000. Probably going to fall to between 2,000 and 4,000, but it might go below 2,000.
I will tell you this: I am wrong less often than every other guest that comes on this program, bar none.
But Peter, you know, as Scott Redler came up to me and he said, oh, Peter's with us. He's been bearish for 10 years. I said, I've known him since high school. He's been bearish since he was 16. But look, it is obviously a time where gold does well. But what's your next trade as you look ahead, Peter? What are you going to be putting money into?
It's not about being bearish. It's being correct. And first of all, this is not about Brexit. Right?
Certificate of state salvage during that time period.
The pullback at the end of trading today was, well, something ominous or just a pause that will refresh. Let's bring in the man who tore up YouTube with his prescient calls on the stock market. He even appeared on this show when the Dow hit 7,500 and warned of more losses. With the Dow now on track for its best July in 70 years, that would be since 1939, is the perma bear ready to come out of hibernation? Let's play bull market or BS with Peter Schiff, president of Euro Pacific Capital. He's on the fast line. Where do you stand today, Peter?
Well, I still think we're in a bear market. I mean, I think the bear market's going to last for a long time. We're clearly in a bear market rally.
What is the worst-case scenario for our markets, then?
Our markets are going lower. This is not just a financial crisis. This is an economic collapse. Our entire phony economy is collapsing around us. There's nothing the government can do to stop it. They should get out of the way and let it happen.
John Brown, senior market strategist with Euro Pacific Capital. Great to see you again, John, because you've made some very interesting comments as of late.
Yeah, it's one of several bear markets on the way to a Dow of about 1,000, in my opinion. And I think it's for 4 fundamental reasons. First of all, consumer shock. Secondly, defaults are rising. Thirdly, there's a spread of socialism even into pay packets on Wall Street. Quite disgraceful and ruining Wall Street. Going to force it abroad.
I think so far, I mean, the problem is these cuts aren't large enough. You know, cutting government spending is good for the economy, it's good for the dollar, but these cuts are trivial. Maybe it's symbolic, but it's not enough to really make a difference. And unfortunately, I think these trivial cuts are going to be more than offset by other increases in government spending that are going to take place throughout the year that are going to dwarf these, you know, minuscule cuts that are part of the sequester.
You mentioned the dollar, and I want to talk to you about that in a moment. But just to look at the stock market for just a second before we do that. We mentioned a second ago, and Stuart Varney was wrapping up his show, how close we are now to this all-time high in the stock market. The Dow's at 14,081, so less than 100 points. 14,164 is the all-time high. What to make of this kind of collective stock market yawn at all the budget talk in D.C.? What do you make of that?
Yeah. Well, first of all, you know, if you adjust the stock market for inflation, we're nowhere near a record high, especially if you use a real barometer, not the CPI. But look, I think the market is missing the boat, missing the point, rather, just like they did in 2007, the last time we were this high. You know, when we were right, you know, around the corner was a financial crisis. I think stock market investors are really oblivious to the problems. They think they've been solved. They think the Fed has an exit strategy that's credible. It doesn't. I think we're still headed headed for a worse economic crisis than the one that we had in 07. But, you know, I think the real damage is not going to be in the stock market. It's going to be in the bond market.
Okay, we can talk about that, but that's obviously, and you're known for strong language, but that's pretty strong language saying we're headed for a worse crisis that's worse than what we went through 07, 08. What do you mean by that? What would it look like?
Well, I think we're going to have a dollar crisis, even though the dollar is strengthening right now against some of the other fiat currencies. Right. I think you're going to have a collapse in the dollar. I think you're going to have a huge spike in interest rates. And I think our whole economy, which is built on the foundation of cheap money, is going to topple when you pull the rug out from under it.
And I don't mean by the day, but when. I mean, is this something that, you know, we could be talking about? You could be coming on for years and then eventually say, oh, yeah, Peter, you were right. Or is it something that's, hey, imminent at this point in your view?
Yeah, it could be years. I don't think it's going to be decades. I mean, I don't think Obama is going to finish his second term without the bottom dropping out. So I think the crisis is imminent. It doesn't mean it's going to happen tomorrow, but I think it's building, and I think I'm more confident of this call than I was about the call I made regarding the housing bubble and the financial crisis. And I think this should be even more obvious. What's amazing to me is the same people that missed the last crisis are oblivious to this one. They've learned nothing from their past mistakes. They just keep on repeating them.
Before the end of a second Obama term. That's the prediction. Peter Schiff.
Peter, good to see you. I mean, looking at my notes here, boy, you sound like a real bear. You think Dow 14,000 is a farce? Talk to us. Why?
Well, you know, everybody acts like this is a big deal, but it's not that the stock market is gaining value. It's that our money is losing value. And so if you have debased currency and inflated currency, the price of everything goes up. I mean, stocks are no exception. If you go back to the last time the Dow was at 14,000 in 2007, gold was at $700 an ounce. Now it's at $1,600. So where's the stock market if you price it in gold? I think that's a much better barometer than pricing them in dollars that the Fed is running off the printing presses by the trillions.
So, Peter, does that mean that the absolute worst thing that you can be sitting on right now is cash?
Well, I've been saying that for a while, and I think the worst cash you could be sitting on is the dollar, although right of the first year he was in office, but it shows me that the temporary euphoria of the stimulus is wearing off. The hangover is setting in. You know, and as bad as things were during the Obama recovery, wait till you see how bad it's going to get during the Obama recession. And I think the Fed is, of course, getting ready to up the dosage of the stimulus. A lot of people were thinking that the Fed was going to take away the money or stop the stimulus. They're not going to do it. They're going to have to up the dosage because $85 billion worth of money printing isn't enough. That's how addicted we are to this cheap money. Interest rates are rising despite this, and the dollar is tanking. I mean, if it wasn't for the Japanese yen, if they weren't trying to act even more recklessly, imagine how low the dollar would be. But I think it's going to break down a lot. That's going to send oil prices. Look at oil prices knocking on the door of $100 a barrel. As oil prices rise, the dollar sinks. More people are going to realize that this economy is in a lot worse shape than they thought.
Why isn't oil high? Because the economy is in better shape. Why aren't yields going up? Because the economy is in better shape. And it must be all those
yields are going up. I mean, yields are going up.
That's
Look at the yield on the 10-year today.
Why are people selling Treasury bonds? If they're worried about the economy, they're not. They're feeling a little bit more comfortable with it. It's why that they would sell bonds and buy stocks.
No, I think they are worried. Look, the European situation is now diffusing. A lot of money was fleeing the euro. Now it's going back to the eurozone. And so people are buying euros, they're selling dollars. And I think more people are starting to recognize that the dollar is going to lose value. So why would you want to own treasuries if the dollar is going down? Meanwhile, a lot of foreign markets are doing much better than the U.S. Look at some of the emerging markets. Look at Southeast Asia. I don't necessarily think people need to be in U.S. stocks. I think there are a lot better opportunities.
Stocks at record highs. The housing market is coming back nicely. I got more on those foreclosure declines shortly. And the economy, it is growing slowly. Some people might say that printing money, good old Ben, has been good for America. Peter Schiff, of course, will not agree with that. And here he is. All right, Peter, before you launch, have you got nothing good to say about what Ben Bernanke is doing? Because he has got interest rates down. He has helped the housing market. He has helped push people into stocks and away from bonds. Come on, he has.
No, I mean this is monetary. We just talking about. Why am I at a loss for words? Monetary caffeine. That's it. That he's injecting into the economy. It's no good. You know, the market is rallying, but it's rallying for all the wrong reasons. Stuart, I mean, if your child brought home an A on an exam, but you knew he cheated on the test, are you going to be proud of him?
Well, okay, hold on a second. You can't just dismiss it. I mean, because a lot of people are making a lot of money. The average wealth of Americans is going up. As homes go up and as housing goes up and as stocks go up, they feel more wealthy. Whether it's because of Ben printing money or anything else, doesn't really matter, does it?
Well, sure it matters. And, you know, people felt great as the housing bubble was inflating in 2003, 4, 5, and 6. We're just blowing more air into the same bubble. Look, if we had a more responsible Federal Reserve that wasn't monetizing all this debt, they weren't printing money and buying treasuries and buying mortgages, if they let interest rates go to a free market price, the Dow Jones would be thousands of points lower right now. And eventually, because this is a phony gain, either all the gains are going to go away when the Fed takes away the punch bowl, or if it never takes away the punch bowl, the gains are going to be meaningless because they're going to be obscured by massive inflation.
Well, hold on a second, Peter. Look, I take your point. I really do take your point. But a lot of our viewers are going to say, well, there goes Peter Schiff all over again. He's bound to be right in the very long term. And you are. There will be another crash and a bubble at some point in the future, and you will be right. Meanwhile, you've missed out, or certainly a lot of our viewers may have missed out on the housing rally and the stock rally because they're listening to you.
Well, no. I'm not telling people not to be in the market. Quite the opposite. I'm telling people that stocks are going to go up. I've been saying that for years. I prefer foreign stocks to U.S. stocks, but I've been telling people for years if the choice is between putting your cash under your mattress or in the bank, buying bonds or buying U.S. stocks, buy U.S. stocks. I'm just not going to lie to myself about why the market is rallying, and I'm not going to pretend it means that the economy is good or that U.S. corporations are really more profitable. They're not. It is all an illusion created by the Fed, and it's going to end very badly. And it's not way off in the distant future. This is not a problem that's going to come back to bite us in 10 years or 20 years. This is looming on the horizon. I don't know if it's this year, next year, the year after, but it's going to be a horrific crisis, much worse than what we had in 2008.
All right. Well, we heard it from you directly. Peter Schiff, we do appreciate that. Thanks very much for being with us again. Gotcha.
Thanks, Stuart.
Market rally have more room to run from here? CNBC contributor Michael Farr says yes, but Peter Schiff of Euro Pacific Capital has his doubts about what he sees in a Fed-driven market. Good to see you both. Thanks for joining us. Peter, let me kick this up with you. What's your problem with this market?
Well, the problem is why it's rising. It's not because the fundamentals are improving. It's because of the Fed. We have cheap money, and so stock prices are going up. But food prices go up, gasoline prices go up, and the macroeconomic imbalances underlying our economy continue to get worse. If the Fed did the right thing and took away the punch roll, the stock market would go down. But instead, we're going to have a crash in the dollar first, then probably the bond market second, and then eventually the stocks will roll over too.
Yeah, but can you really say that? I mean, don't you think today's move, I'm just saying today's move, don't you think that's because of the jobs numbers that we got today?
Well, the job numbers weren't as bad as people were expecting. I wouldn't say it was a good report. In fact, if you look beneath the surface, it gets even worse. We didn't create any manufacturing jobs. We created a bunch of low-paying service sector jobs. A lot of them are part-time. Hours worked went down. I think what's happening is you have restaurants that are reducing the hours worked to get people under 30 hours to get out from under Obamacare, and so now they have to hire somebody part-time to fill up the slack. Those are the kind of jobs we're getting. Look at the U6 unemployment, which doesn't count those people as being employed. It notched up to 13.9%.
What do you think about that, Michael Farr? You're on the other side of that trade, aren't you?
Peter's, well, yes and no. I mean, I don't think Peter's wrong here, Maria, but, I mean, the market's moving higher. We've got a Fed that's got its foot to the floor here. We've got lots and lots of cash coming in. We've got Maria wearing her green jacket on the floor of the exchange when the market's making new highs. I mean, come on, how can you bet against that market? Relative to bonds, stocks continue to be attractive. I'm always cautious as I manage other people's money, but this trend is going higher, and I don't think we're anywhere near some sort of frothy blow-off stage yet. So while stock selection gets to be very important, I think this thing has room certainly to go. It could pull back in the short term, but we'll see higher levels.
Yeah, well, we got the buy on the dip mentality very much in place, Michael. So even if we were to pull back, we've got buyers at the ready here. But let me ask you a question about the Federal Reserve, because at the end of the day, it really is about the Fed. When do you think that the Fed is going to start winding it down?
You know, I listened to Steve Leisman earlier on your show, and I thought he made a very good point. They're sort of adjusting out a couple of months sometime in 2014 as to when they may pull back. The Fed's been keeping our campfire of this economy alive by pouring kerosene on it. Will it have a life of its own and continue to burn without that kerosene? That's the real question. Yeah. But, you know, what I kind of say to Peter is...
It's not a question in my mind. You don't want to listen to Steve Leisman. But, you know, the Ben Bernanke is going to keep printing until the dollar crashes, right? There is no exit strategy. The Fed is bluffing. We have a completely phony economy that is driven 100% by cheap money. The minute you take it away, the whole thing implodes. But Ben Bernanke can't admit that because then, you know, the cat's out of the bag. So the QE is going to be here until we have a crisis in the dollar and the Fed can't get away with it anymore.
They could hold it for a while, Peter. They don't have to absolutely exit out of that huge portfolio. But won't you admit sort of that the general trend in the economic data is improving?
It's not. It only looks like it's improving because of the cheap money. And they cannot exit. Exit is impossible. Okay. They are the bond market. They're the buyers. They can't sell.
The data are improving because of the cheap money and because of what the Fed's doing. We hope that we will hit some sort of escape velocity and the economy can take on a momentum of its own when the Fed pulls back.
The cheap money is making it worse. It's taking a sick economy and making it sicker. It only feels good. Just like if you're a drug addict and you take more drugs, you feel better, but you're not getting healthier. The cheap money is preventing the economy from getting healthier.
I've always wanted to figure out that drug addict thing. I've never gotten onto that one yet.
Let me ask you this, Peter, because, I mean, you make a lot of good points, but at the end of the day, this is reality. This is where we are. The Federal Reserve is on QE infinity, and that's the bottom line. Just yesterday, they said, look, we could even increase it from here. So this is the reality that we face. Whether or not this is a manufactured market or not, basically suggesting what you just said, you've got no alternatives to stock. So why am I going to get in front of this moving
yes, you
trade?
do.
What is my alternative?
I mean, look, you know, copper was up 6.5% today. Look at the big move up in oil. But you can invest in foreign stocks. The dollar was actually softer today. But I know what the reality is. The reality is we're living in a bubble. But all bubbles burst. It's unfortunate we didn't learn that lesson in 2008, but we're about to learn a much bigger lesson. Because when this bubble bursts, it's going to make 2008 look like a Sunday school picnic.
I want to bring in Peter Schiff, CEO of Euro Pacific Capital. He correctly predicted that the housing market crash would overwhelm the financial system. He's also the author of The Real Crash, America's Coming Bankruptcy, How to Save Yourself and Your Country. Mr. Schiff, thanks for being here. So should we be happy that the Dow's hitting 16,000, or should we be scared?
Well, not if you're concerned about the economy. You know, the rise in the stock market, it's not because of a good economy, but because of bad monetary policy. What's driving the rally is the Fed pouring all this cheap money into the market. But if they ever do the right thing and turn those spigots off, the market's going to come crashing back down.
How far down do you think it would come crashing down, back to where we started the year at 13,000?
Well, we will go a lot lower than that if the Fed moves away the monetary props. See, the problem for the economy is what the Fed is doing to goose the stock market and the housing market is actually hurting the real economy. It's preventing it from restructuring in a positive way that would produce genuine economic growth and prosperity that would be enjoyed by everyone. Instead, the Fed is enriching the few at the expense of the many.
So, Mr. Schiff, for those who have their life savings in the market right now, should they be worried now? Should they be worried when they hear more directly that there will be a tapering off of this stimulus, this Fed stimulus? When should they be concerned?
I don't think the Fed's going to taper. I think the people who should be the most worried are the people who have cash in the bank, the people that own government bonds. I actually think you're better off being in the stock market. Even though the rally is phony, it's probably going to continue because the Fed doesn't have the integrity to do the right thing.
What do you think about those who wonder if there's a Janet Yellen effect, the pending Fed chair? Do you think that investors possibly are feeling comfortable about her, that she will become the Fed Reserve Chair. She won't immediately scale back the stimulus program you're talking about, that might be some of the reason here.
Well, yeah, well, she's going to increase. She's going to crank it up. She's going to do more stimulus. And remember, Janet Yellen, despite the way the media tries to redefine her, was just as clueless as everybody else. She never warned about anything with respect to the housing market or the financial crisis. In fact, she dismissed the warnings that other people were making. She said there was no bubble. She thought real estate prices would keep on rising, and she thought that even if they went down, which would have surprised her, it wouldn't hurt the economy. That's how little she understood about the economy or the real estate market. So I think it's very dangerous to have Janet Yellen as a Fed chairman. It is going to be more of the same. That's why the economy is going to continue to get worse.
Peter Schiff, thank you so much for your views. We appreciate it.
Thank you.
Psychologically, I think investors look at these large numbers in the S&P and Dow, and when we cross these thresholds, it is a confidence booster for investing, for the market, and for the overall economy. You know, the overall sentiment in this market has been moving higher. Pretty big move in the market on Tuesday. No profit taking yesterday, which would have been a natural, healthy movement in our market. So without that pullback yesterday, it was naturally going to move higher today. Everyone was waiting for this job number. It was already priced in very significantly into our markets that we were going to expect a good number. All the economic data is really the driver in what we've seen so far. You couple that with earnings season and the forecast for what we're anticipating for the rest of the year. Put that all together, and that's really the force that's behind this market. A few geopolitical headlines that are out there that could have a little bit of a gray cloud over our markets, and we've seen those effects. But